Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Stocks extend to new all-time highs. Well, despite a lot of things out there to worry about, stocks were able to shrug off a mid-June pullback to trade to new all-time highs this past week. In fact, the S&P 500 index has made a total of 35 new all-time highs just so far this year. So with some concern over new strains of COVID and an uptick in the so-called Delta variant, why is the stock market seemingly so unconcerned? Well, the biggest reason is that corporate earnings estimates continue to get ratcheted higher. In fact, over the last 3 months, earnings estimates for the second quarter of this year are up more than 10%. Markets also love to climb a wall of worry. When investors are nervous or pessimistic about things, they tend to keep excess money in cash. That presents potential fuel to push stock prices higher as some of those pessimists get converted to optimists. Also, economic data has been strong enough to keep those corporate earnings estimates moving higher, but not too strong so as to make investors nervous that the Fed might take away the punch bowl a little bit too early. It's a recipe for stock market to continue to move higher in the near term. For this week's featured insight, fixed income is still important. Well, with interest rates at ridiculously low levels, a lot of investors are starting to question whether it still makes sense to have fixed income or bonds in their portfolios. The short answer, unless you're extremely young or have a very high tolerance for risk, is absolutely yes. The biggest reason is that you can have some safety and liquidity in your portfolio in the event you need funds during a market downturn. For example, would it have made sense to have to sell stocks into a market downturn like in March of last year? Probably not. Lastly, you can still earn attractive total return even from investments that have low yields. For example, Treasury inflation protected securities, or TIPS, have a total return of over 6% in the last year. Foreign bond portfolios have earned double digits in the last 12 months as a decline in the value of the dollar has pushed the price of those assets higher. Looking ahead, July is strong in post-election years. The month of July is historically a pretty strong month during what is usually a very dull period in the summer months when trading activity dissipates, mostly due to the fact that a lot of Wall Street has gone to the beach on vacation. In fact, in post-election year Julys, July is actually the strongest month of the entire year on average since 1950, with the S&P 500 returning an average of 2.2% for the month. It's August and September that investors really need to worry about. Those are historically, on average, two of the weakest months of the year. Now, before you go out and sell all your stocks at the end of July, I would caution investors to obviously not do that, but it could make sense to use the end of July as an opportunity to rebalance portfolios, harvesting gains in asset classes you're overweight, and recycling those funds into adding to asset classes that you're underweight. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.